Forget the S&P 500. Forget the latest IPO. The single most complex and potentially volatile asset you trade with every single day is actually the one sitting right above your neck. Today, we are diving deep into the profound and often painful influence of psychology and biology on financial decision-making.
It's all about that core tension, isn't it?
Exactly. The rational, thoughtful cortex clashing, sometimes violently, with the primitive, instinctual limbic system every time money is on the line.
And that tension, for you, the investor, is, well, it's the entire game. Your mission in this deep dive is to gain a fast, thorough understanding of these, irrational forces driving your behavior.
And crucially, to find techniques to manage them.
We have to stress this because to truly excel in investing, you need more than book smarts. You need self-management skills, the ability to control the emotional climate in your own skull.
And we have immediate, just irrefutable proof that mathematical genius, scientific acumen, and creative brilliance offer zero insulation against psychological failure. We're going to run through 3 famous financial failures just to prove the premise right off the bat.
Okay, let's start with long-term capital management, LTCM.
Right.
This fund was built by John Meriwether, a man famous on Wall Street for controlling his fear and greed, and his co-founders included Nobel laureates.
Robert C. Merton and Myron S. Scholes, I mean, these were minds built for pure logic, for mathematical perfection.
They raised $1.25 billion in 1994. At the time, that was the largest launch in history.
And the initial returns were spectacular. People thought they were infallible.
But then within 5 short months in 1998, they lost 90% of their assets.
90%. And it nearly caused a global financial meltdown. The Federal Reserve had to step in with a bailout.
The irony is just crushing. They made these highly leveraged, statistically sound trades, but after years of success, the root causes of the collapse were purely psychological.
Arrogance, hubris.
A collective belief in their own invincibility. They became psychologically incapable of even considering that their models might be wrong, or that they were taking way, way too much risk.
So how did such smart people fail to spot their own hubris? Was it internal peer pressure, or did the success physically change their perception of reality?
That's the exact question we'll answer later with neurofinance. But the pattern is centuries old.
Yeah, look at Sir Isaac Newton, the father of classical physics.
Right. In 1720, during the South Seas bubble, he actually analyzed the situation, predicted the crash.
And sold his shares for a huge profit. Something like £7,000, pure intellect won.
For a moment. But then he watched the price continue to soar and soar.
Oh, that primal fear of missing out. FOMO.
He completely succumbed to it, reinvested at a much, much higher price. And when the crash finally came, he lost over £20,000.
The fortune.
He was broken by it. He famously said afterward, "I can calculate the motions of heavenly bodies, but not the madness of people."
That's a genius admitting the limits of pure intellect when faced with the gravity of market panic.
Exactly. And you see it again with someone like Samuel Clemens Mark Twain.
The great humorist. He fell victim to the silver fever in Nevada in the 1860s.
He started accumulating substantial paper stock wealth. He even had a plan.
A plan to sell when Nevada became a state, but the rapid gains, they just stoked this profound sense of invincibility.
And he deviated from his plan. He stopped paying attention to fundamentals, and almost overnight, he found himself virtually broke.
Financial failure so often begins when that illusion of success replaces prudent management. Okay, so we've established that raw brain power is not enough. But why? What is actually happening inside our heads?
Well, let's turn to a field that gives us the biological answers. Neurofinance.
Which is a fusion of, what, finance, psychology, neuroscience?
Economics, yeah. It confirms that the core tension isn't just behavioral, it's architectural. When you face an investment decision, you have 2 major systems battling for control.
Think of it like this. You have the thoughtful driver, which is your cortex. It evolved relatively recently, about 100,000 years ago. It's capable of planning, calculating.
Self-control.
Oh, right. And then you have the passenger.
Your limbic system. This is the primitive, instinctual, emotional brain we share with, our pets.
Yeah.
It reacts lightning fast to reward and threat.
So the cortex attempts deliberate control, but in fast, scary, or greedy markets.
That ancient emotional system usually grabs the wheel first. Unless, and this is key, unless the investor is highly trained.
And that system is driven by chemicals. What's fascinating here is that your trading performance is actually deeply influenced by your neurochemical state, not just your balance sheet. Let's talk specifics. Let's start with the biggest driver of irrational excitement, dopamine.
Dopamine is the excitement chemical. It fuels reward-seeking behavior, and it helps the brain lock in patterns.
Feels good.
It feels great. And while it's essential for motivation, in trading it often translates into overconfidence, especially after a winning streak. It makes you feel good about taking more risk.
So it encourages you to immediately look for the next trade, often ignoring your own risk management plan.
You're chemically wired to chase that high.
It's the reason why, after you hit a big winner, your rational mind sort of goes on vacation for a week.
Exactly. But then, conversely, when things go sideways, we get hit with cortisol and adrenaline.
The stress hormones.
These drive fear, panic, and that sudden, overwhelming urge to just hit the sell button. This leads to those premature exits we all regret.
And the deep problem here is that chronic stress, you're constantly monitoring, constantly losing money, it impairs your judgment.
It damages your memory. It essentially degrades your analytical tools right when you need them most.
We can't forget serotonin either.
No. This neurochemical is crucial for patience, for emotional balance. And research has actually observed a distinct link between collective increases in serotonin and the formation of market bubbles.
So you're saying our collective mood, our chemical state, can actually create a bubble.
It demonstrates how broadly emotional and chemical states can affect collective judgment. It confirms that the market's behavior is often just a massive chemical feedback loop.
Okay, that's the architecture and the chemistry. So if the chemistry is driving the car, what are the specific behavioral road signs, the biases that keep driving us into a ditch?
Let's move to the concrete cognitive biases identified by behavioral finance.
We have to start with the deepest pain point, loss aversion.
Loss aversion, a term from behavioral economists, dictates that the pain of a loss feels roughly, well, twice as painful as the pleasure of an equivalent gain.
That 2-to-1 ratio is critical to understanding so much market movement. And it helps explain something really complex called the equity premium puzzle.
Right. Simply put, stocks historically deliver a much higher return than bonds.
But if people were purely rational, that premium, that extra return, shouldn't need to be so high.
The puzzle is solved when you realize people demand such a high premium to enter the stock market because they have such a powerful, painful aversion to the risk of losing money.
And loss aversion's behavioral manifestation is the infamous disposition effect.
This bias causes investors to do two things that pretty much guarantee underperformance. First, selling winners early to lock in the gain and get that dopamine hit.
And second,
holding losers too long, desperately hoping for a comeback rather than just realizing the painful loss.
I think every investor listening has stared at a stock they bought for $50, watched it drop to $5, and refused to sell, saying,
"Oh, wait till it gets back to 50 just to prove I was right."
Yes, that need to break even is a purely emotional loss avoidance signal. It has nothing to do with the fundamental outlook of the investment anymore.
Next up is the hubris trap, overconfidence. As we saw with the LTCM partners, success literally changes your brain chemistry.
It generates an illusion of control.
It's exactly. After a series of wins, investors start dismissing risks. They stop paying attention to the prudent management that got them there in the first place.
It's the Mark Twain effect, that sense of invincibility. And interestingly, studies specifically point out that male investors often exhibit greater overconfidence,
which leads to higher trading volumes and, statistically, lower net returns. Overconfidence just compels action, even when the data doesn't support it.
That hubris often pushes people straight into the herd mentality.
Herding is just following the crowd. Not because you've done your own research, but because of social proof and emotional pressure. This is what dramatically amplifies bubbles and crashes.
You see echoes of this behavior in classic psychology, right? Like the Asch conformity experiments.
Where people chose the obviously wrong answer just to agree with the group.
Yeah. And when investment committees meet, the analysts with the loudest voice or the most authority can create a herding habit. No one wants to be the contrarian who calls out the consensus trade as dangerous.
The solution here is committing to what we call the contrarian lifestyle, developing and protecting your capacity for independent thinking.
Finally, let's touch on the cognitive biases related to data interpretation, the illusion of pattern.
Our ancient brains are hardwired to find patterns for survival. We see shapes in clouds, faces on Mars.
And in finance, this translates into seeing patterns even in pure randomness.
This is why data mining and overfitting models create such a false confidence. We believe we found a signal, a predictor, when it's actually just noise.
You found a pattern that worked last week.
But it offers zero predictive value for tomorrow.
And that illusion leads directly to the gambler's fallacy.
The incorrect, deeply ingrained belief that past random events influence future random events.
This is why so many investors over-rely on technical charts. They think that because a stock has gone down for 6 days in a row, it must be due for a bounce tomorrow.
But the market doesn't owe you a bounce just because you feel it's due. So we've established the chemical and the psychological forces at play, which raises a really critical question. If pure intelligence, the Sir Isaac Newton model, can't stop you from making a mistake, what practical steps can you actually take to manage these powerful biases?
Right. It's no longer about intelligence. It's about structure and self-awareness. What is the most crucial, actionable tool you recommend for reducing biases?
Maintaining a decision journal. This is a key self-help exercise.
Okay, what does that involve?
Before you execute a trade or make a major investment decision, you have to write down 4 things. Your thesis, so why are you doing it? The evidence supporting it. Your emotional state at the time.
And the fourth?
Pre-commitment. When and why you will sell, regardless of the outcome.
Why is that administrative paperwork so effective, especially when people are already stressed? I mean, isn't just focusing on my breathing enough?
It's effective because it helps you defeat the most insidious cognitive error of all, hindsight bias.
The tendency to rewrite history.
Yes. Remembering wins as strokes of genius and forgetting losses as unavoidable external factors. The journal forces you to measure your decision quality in the moment, rather than just judging yourself based on the outcome later.
It creates a concrete record that prevents your mind from lying to you.
Exactly.
Beyond rigorous logging, let's talk about emotional regulation. These biases manifest as physical stress and impulse. What non-financial tools are effective here?
We can import techniques directly from clinical psychology, things like cognitive behavioral therapy or CBT, coupled with practices like yoga, meditation, even simple deep breathing, stress reduction. They're profoundly powerful.
They don't just reduce stress, they improve emotional control.
And remember, the brain can change. This is neuroplasticity. You can literally rewire circuits. Developing self-discipline and maintaining learning goals, which are focused on process mastery.
As opposed to just outcome goals, which are focused on profit.
Right. That's critical for that rewiring.
We also have to talk about counteracting impulsivity. This is where time discounting lives. Explain how that works and why it sabotages our long-term wealth.
Time discounting is our brain's tendency to prefer an immediate smaller reward over a larger future gain. It's pure limbic impulse.
Okay.
In trading, this manifests as overtrading, constantly chasing small, quick profits and cashing out a small winner too soon, instead of patiently letting a massive long-term compounder run its course.
So we're trading the big, delayed reward, actual wealth, for the immediate dopamine hit of a small, closed trade. What's the defense?
Discipline and pre-commitment devices. This could mean automating your investing so that you remove the decision point entirely.
Or using hard stop-loss orders.
Exactly. Orders that execute without your emotional intervention. You are designing a system that relies on your rational cortex before the market opens, so your impulsive limbic system can't derail you when the stress hormones are flying.
And the ultimate payoff for all this self-mastery is securing the behavioral investing edge.
Precisely. Market inefficiencies don't arise because the math is hard. They arise from collective biases.
So when thousands of investors are simultaneously affected by dopamine-fueled greed or cortisol-driven panic,
they create mispricings. The successful investor is the one who acts rationally and dispassionately amid those emotional markets.
That's the arbitrage. You're finding these guaranteed opportunities because you're the only one disciplined enough to be rational, while everyone else is driven by their loss aversion or their hubris.
This understanding is the fundamental basis for successful, disciplined strategies like momentum investing, value versus glamour, size strategies, really for exploiting any defined risk premia.
So we have traveled from the colossal failure of mathematical geniuses at LTCM and historical pain of Sir Isaac Newton through the specifics of how dopamine spikes affect overconfidence and the behavioral pain of loss aversion.
We even covered the practical tools of journaling, emotional regulation, and pre-commitment.
But the central thesis remains:
the investor's greatest opponent is not the market, not the Federal Reserve or inflation. It is their own brain.
And mastery comes from understanding, training, and respecting the psychology behind every single financial decision you make.
Yeah.
So what does this all mean for you as you reflect on this material and, your own trading habits?
Let's close with a thought from history.
Okay.
Back in the early 1900s, the investment periodical, The World's Work, concluded that enthusiasm, lust for gain, and gullibility, not sober common sense, are the real bases of speculative trading.
Wow. So if the psychology of speculators remains remarkably similar over centuries,
Then you need to ask yourself this provocative question as you close this deep dive. Are you truly modeling the successes of the rational, disciplined investors?
or are you unwittingly modeling the centuries-old mistakes inherent in human nature?